Okay, I'm chuckling because I actually had to splice two videos together because I went through the entire hourly analysis only to find out that the video recording was paused. I think I'm up to like my favorite 100 reasons why I hate computers. Although that was operator error, so I can't blame the computer. Okay, so on an hourly time frame, let's go ahead and zoom out, and we're going to be looking at this area of the chart in October where the market didn't go anywhere, at least on a daily basis, and we'll talk about some of the trade opportunities and some of the setups that were available. You can see here that this, if you were fast, I could see how you'd make a case for the weave over here, and that the moving averages laid down and were one right on top of each other. The market had just come out of a huge move to the upside, so the range did narrow down drastically. So I could see how you would make a case for the weave beginning at that level, in which case would put the entry here or here. You can see the market broke, came back, retested this level, chopped around for a little while, actually started into another second kind of weave before finally breaking down, but then going nowhere. This is really the main difference between a weave that takes many, many bars to form and one that maybe forms over 5 or 6. It's a well-documented and observed phenomenon in the marketplace that when you see the range go narrow for an extended period of time, the market tends to break out in an extended way. In other words, if you look at the breakout over here, you've probably got about 60 points where the market didn't really get much beyond that. But then over here, when the market goes into the weave for almost 2 days, we can see, boom, the market breaks out and you've got probably 100 pips to the downside. Okay, so a significant difference in how the market moves. I don't want to gloss over the fact that once again the market, boom, forms a little dipper. Okay, this time coming back all the way into the weave itself. You can see here, moving averages separate very quickly. They get a lot of space. Now they're starting to come back into a weave. The market has gone from a wide range to a very narrow range. This is exactly what we want to see. But don't jump the gun yet. I am not going to use this as an entry or this. I want to see these moving averages come together and start to weave. Now here again, this is some of the difficulty of going back in the past. You can see they've just now barely crossed, and now they've started to come together. At the close of this bar, we could say, all right, we've got a weave, but we don't have an entry other than a long entry back there. Okay, so just keep that in mind. While we're zooming through this, it may look like we had a trade, but if we're honest and really look at it, you can see by the time the market confirmed the weave right here, we were well below that low. And if that's the case, I don't take the trade. Okay, so the market separates. We no longer have a weave, no entries. Now, the question might come up, well, what about using this hand back here for a potential entry? I would rather wait with intraday trading especially. I don't want to go very far back intraday at all because it's such a small time frame. I want to trade as the market is forming the weave or just breaking out of it. I don't want to try and go back here and say, okay, I'm going to trade above there and I'm going to trade below there. I don't like doing that. The market's too volatile and it changes way too fast. So again, I prefer to trade as the weave is forming. So what that means is if you're trading intraday, you're not going to be able to come up with an autopilot trade very easy. Here we go. Market expands, boom, contracts, we have the weave.